Hi there, good morning once again. It's Victor here again, just bringing you an update of market happenings over the last week and what we expect going into this week. We start off again in the US, where markets essentially slid on Friday, ending a 5-week winning streak as hot inflation numbers stoked fears that the Fed was going to cut rates much later on in the year. I mean, the expectation had been that the Federal Reserve was going to start cutting rates in the first half of this year. But with that hot inflation number that we saw last week, I mean, the expectation now is that the Federal Reserve is likely to cut rates much later on in the year. The S&P fell 0.48%, the Nasdaq was down 0.82%, the Dow lost 0.37%. For the week, the S&P lost 0.42%, the Dow lost 0.11%, while the Nasdaq was down 1.34%. Also, last week we saw, producer prices, which essentially is, a gauge for wholesale inflation. It rose 0.3% against an expectation that it was going to rise 0.1%. We saw the 10-year US Treasury basically spiked to about 4.3% following that hot PPI reads. That's the highest that we've seen, on that Treasury yield in about 10 weeks. This week really has largely been about inflation. It's been driven by that inflation data. On Tuesday, the Dow posted its strongest one-day decline in almost a year when CPI came in hotter than expected at 3.1%. Coupled, of course, with the stronger PPI data that we saw, inflation is essentially proving sticky downwards. And this is, like I said earlier, it's going to cause the Fed to basically delay, its rate cuts, into the rates that we've seen, so far. So that's likely to then happen much later in the year. And this certainly has implications, for markets and for sentiments, going forward, really. For the remainder of this week, really, we still have earnings coming through. About 15% of S&P companies are slated to report this week. NVIDIA is also slated to report as well. All eyes will certainly be on that to see what that number turns out to be. I would also be expecting the minutes of the last Fed meeting on Wednesday. We also have about 5, Fed officials that will be speaking in the course of the week as well. Markets will basically be looking to clues as to what their thought process is, what their thinking is in terms of the timeline, for those rate cuts. Going into the rest of the global economy, particularly the recession stories, really, we saw the UK and Japan basically slip into a recession, technical recession, really, with data that was released last week. GDP in the UK shrank 0.3% in the fourth quarter of the last quarter of last year. Its 3 main sectors basically contracted. Services was down by 0.2%. Production shrank by 1%, while construction was down by 1.3%. Although this is expected to be a short-lived recession, as the consumer remains really resilient, unemployment levels are still low, but inflation remains the biggest headwind, to growth in the UK. Because what this will do is ensure that the Bank of England keeps, interest rates higher for longer to tame that inflation, and this will certainly, hamper growth, really. Also, Japan unexpectedly fell into a recession, essentially hurt by weak domestic demand. GDP contracted by 0.4% in the last quarter of last year against an expected growth of 1.4%, really. Revised GDP for the third quarter of last year was down 3.3% as well. Private consumption declined by 0.2%, in Japan as well. I mean, this recent, GDP number really complicates the case for the BOJ normalizing interest rates, really, because it had been on a tightening stance, with growth basically essentially receding. It becomes somewhat difficult to maintain, that tightening stance. It, however, remains to be seen how the BOJ then, does react to this number. Also, that latest GDP number means that Germany has now surpassed Japan as the third largest economy in the world, at least in USD terms. Over in Nigeria, we saw inflation data for the month of January. We saw that read come out last week, came in at 29.9%, about 1% higher than the previous month. Inflation is still running very hot. Food inflation about 35%. Again, this cements the case for a significant tightening at next week's monetary policy committee meeting, the first of the new central bank governor and the first this year as well. Also, if you look at the fixed income market, last week it was largely bearish, really. Demand was, basically subdued last week as participants looked forward to the primary market auction that will be happening on Wednesday this week. In all, yields rose by about 40 basis points across the Treasury bill curve. If you look at the bond market, the sentiment was largely the same as well, particularly with the release of the February. That we have seen in a really, really long time. I'm not even sure that we have seen auction size this large ever, So again, the sentiment is that yields are going to come up higher. The auction is happening today. So really all eyes on the DMO to see how this auction closes. There have been concerns around the liquidity in the market and whether the local market can take that up. There are also, thoughts around the fact that the DMO is probably expecting some foreign funds to come through. And maybe that's the reason it's issuing as much as this. But nevertheless, I think that the outcome of the bond auction today would really determine and direct, the path of the fixed income market for the remainder of the week, coupled with the outcome of the primary market auction as well. So we'll basically continue to keep an eye on that and see how things pan out, whilst look forward to the outcome of the Monetary Policy Committee meeting that will be happening next week. Thank you very much for your time. We do hope that you have a very productive week. Thank you.